Trump's tariff war was sold as a way to bring jobs back to America, but the outcome looks very different. Instead of reshoring factories, Washington has pushed much of the world into each other's arms. Across Asia and beyond, new alliances are taking shape, and the BRICS, together with the SCO, are laying the foundation for a self-sufficient system that doesn't need the US. The results are already showing. America's great engine of consumption is slowing down as households pay more but get less, while China, India, and Russia are linking their strengths in labor, manufacturing, and resources. Add to this the surge of gold and silver, breaking long-standing records. And it's clear the global financial order is shifting. This isn't a temporary storm. It's a structural change that could reshape power for decades. Let's unpack how it all came together and why Washington is losing control. Trump's trade war has become the biggest self-inflicted wound for the American economy. What began as a promise to protect workers has turned into a global backlash. Tariffs that were supposed to pressure rivals are now hitting friends and allies, and the cracks are spreading across the system. Look at the numbers. Only a year ago, US household consumption was still rising at around 4% on a 6-month basis. Today, it has collapsed to nearly zero. Families are paying more for food, fuel, and goods, yet their living standards are falling. Prices are inflated, but the value they receive keeps shrinking. In plain terms, Americans are paying more and getting less. This is not just an American story. The tariffs have alienated key partners who once relied on US protection. Members of the G7, long treated as close allies, now see loyalty punished rather than rewarded. Canada and Europe face steep duties on steel, aluminum, and cars. Japan and South Korea are navigating rising costs in semiconductors and shipping. And India, a country Washington has courted for years, was suddenly hit with tariffs as high as 50%. For Delhi, the message is unmistakable. Hedging between Washington and Beijing is no longer possible. When loyalty is penalized, there is no incentive to stay in line. That's why India is warming up to Moscow and Beijing, while US credibility suffers. The wider effect is clear. America has locked itself into a defensive position, unable to invest abroad without political backlash, and unable to keep domestic prices under control. Meanwhile, competitors are linking arms and pooling strengths. Tariffs were meant to show power, but instead, they exposed weakness. With consumption stalling at home and partners drifting away abroad, Washington is left isolated. And into that vacuum steps a coalition that sees opportunity in America's mistakes. Their plan is to combine labor, manufacturing, and resources into something Washington can't easily block, setting the stage for a new balance of power. The image of Narendra Modi warmly embracing Vladimir Putin sent a clear message to the world. India is no longer trying to balance evenly between Washington and Moscow. That moment captured the shift of Asia's third-largest economy toward the orbit of Russia and China. And it isn't just symbolism. Behind the smiles lies a strategic triangle forming around labor, commodities, and manufacturing that could transform the global economy. India brings the fastest-growing labor pool in the world. More than 10 million young people enter its workforce each year, many of them skilled in technology and engineering. Russia holds the resources every modern economy needs, from crude oil and natural gas to uranium, wheat, and industrial metals. China contributes the full spectrum of manufacturing capacity, from electronics to solar panels, along with a logistics network that stretches across Eurasia. Together, these three cover the backbone of global industry. Beijing is accelerating this alignment with money. At the latest summit, China pledged $10 billion in new loans and 2 billion yuan in grants to SCO partners. While the amounts may sound modest compared to Western programs, they come with fewer conditions and flow faster than loans from the IMF or World Bank. For countries in Central Asia or Africa struggling with infrastructure gaps, that flexibility matters more than the headline figure. This financial push is designed to insulate members from US pressure. Washington cannot easily sanction or block projects when they are funded and built inside a China-centered ecosystem. Factories, pipelines, and power plants financed under this scheme will source equipment from Chinese suppliers and raw materials from Russia, creating circular demand that strengthens the bloc. For India, the calculus is simple. With US tariffs as high as 50% cutting off access to American markets, it cannot rely on Washington for growth. By tapping Chinese finance and Russian commodities, India gains stability while still pursuing its own ambitions as a rising power. What is emerging is more than a partnership of convenience. It is the framework of an alternative order, one in which supply chains, finance, and resources are anchored in Eurasia rather than the West. This triangle is not just hedging against America, it is laying the foundation for an ecosystem that can run on its own terms. And it's already beginning to reshape the global balance. Beneath the deserts and mountains of Central Asia lies one of the world's least tapped treasure troves: rare earth minerals, copper, uranium, and lithium. These resources are the essential inputs for modern industries. Smartphones, electric vehicles, fighter jets, and advanced batteries all depend on them. For years, the region remained underdeveloped because the infrastructure was poor and the technology required for extraction was limited. That's now changing, and China is positioning itself as the gatekeeper. Beijing has both the capital and the expertise to unlock these reserves. Chinese companies already control more than 70% of global rare earth processing, and they have the equipment and logistics networks to expand further. Through loans and infrastructure projects, China is tying Central Asia's mineral wealth directly into its supply chain. That means when new mines or processing facilities open, the output doesn't flow to global markets in dollars. It moves through Chinese-built pipelines and railways, often priced in yuan. Washington, in contrast, is boxed in. Investing heavily abroad has become politically toxic at home, especially when voters are told those funds should support American jobs. Imagine Trump announcing billions for mines in Kazakhstan or Kyrgyzstan while factories in Ohio struggle. The backlash would be immediate. This domestic constraint leaves the US sidelined just as the race for critical minerals heats up. The strategic consequence is obvious. By building out supply chains that start in Central Asia and end in Chinese factories, Beijing is creating a near monopoly on the materials of the future. From semiconductors to renewable energy, any country that wants access will have to go through China. This isn't just a matter of trade. Control of critical minerals means leverage in diplomacy, in defense, and in technology. And with Washington unable to compete in the region, the resource map is tilting east. The stage is set for the next confrontation. Not about tariffs, but about who holds the keys to the world's industrial engine. The dollar has been the backbone of global trade for nearly 8 decades, but that dominance is beginning to erode. The latest trade data shows why. From January to June, China's trade with BRICS members and their partners reached nearly 6 trillion yuan, about $855 billion. A 4% increase even as global trade slowed under Trump's tariffs. The crucial detail is not just the volume, but the currency. More of these deals are being settled in yuan, bypassing the dollar altogether. Central banks are also shifting. In the last 8 months alone, the dollar index has fallen by around 10%, while gold's share of global reserves climbed to 24%, the highest in 3 decades. This isn't symbolic. It means governments are preparing for a world where the dollar's safe haven status is no longer guaranteed. The IMF's latest survey shows the dollar's share of official reserves sliding to just 42%, the lowest since the mid-1990s. Gold and silver are filling the gap as stores of value. Both metals have surged as investors look for protection against currency volatility. Silver, in particular, has gained more than 36% over the past year, while gold reserves held by central banks are at record highs. This shift matters because trade and reserves work together. If commodities are bought and sold in yuan and reserves are stored in gold, the dollar's grip on the global economy weakens. For Washington, that translates into fewer tools to enforce sanctions or fund deficits cheaply. For Beijing and its partners, it means freedom to expand trade on their own terms. The financial map is redrawing itself, and the US is watching its greatest advantage quietly slip away. India's latest moves show a quiet but firm break from Washington's expectations. Despite US pressure, Delhi has doubled down on buying Russian oil. In July alone, India imported more than 1.9 million barrels per day from Russia, making Moscow its largest energy supplier for over a year. The government's argument is straightforward. If India stopped buying, global oil prices would spike, hurting everyone, including the United States. The reset goes beyond energy. Defense trade tells a similar story. Over the past 2 decades, India signed more than $20 billion worth of contracts for US weapons, from helicopters to surveillance aircraft. But today, that represents less than 9% of India's total arms imports. By contrast, Russia still accounts for about 40%, and Israel is rising fast as a supplier. With US tariffs straining relations, it is unlikely that Boeing, Lockheed, or Raytheon will win more deals soon. Symbolism is also shifting. Direct flights between India and China have quietly resumed after years of suspension, signaling an openness to restore commercial and people-to-people links. For Modi, ignoring Beijing is no longer an option, especially when China controls much of the technology and supply chains India needs for growth. Taken together, these moves reflect a simple calculation. India cannot abandon Russia without losing its main energy lifeline, and it cannot distance itself from China without risking isolation in Asian trade. The package is inseparable. This reset is not about choosing sides in an old Cold War framework. It is about survival in a new global order, where tariffs and sanctions have made neutrality impossible. And with Delhi leaning closer to Moscow and Beijing, Washington faces the prospect of losing one of its most important partners in Asia. The surge in precious metals is more than a market story. It's a signal of how fragile the dollar has become. Silver has broken through $40 an ounce for the first time in 14 years, gaining over 40% this year alone and more than 130% in just 2 years. Gold has also soared, with central banks adding to their reserves at the fastest pace in decades. Tightness in the London market underlines how severe the shift is. Lease rates for silver, which were near zero for years, have jumped by more than 200 basis points. Traders and industrial buyers are scrambling for supply, and withdrawals from vaults are accelerating. With silver essential for semiconductors, solar panels, and electric vehicles, shortages mean higher costs across entire industries. In Washington, alarm bells are ringing. US officials are preparing to add silver to the list of critical minerals, a move that could pave the way for government stockpiling. But developing large-scale mining at home is expensive and slow, meaning the US may be forced to compete in global markets at a time when China already dominates processing. Gold is sending a similar warning. Its share of global reserves has climbed to 24% this year, the highest since the early 1990s. Meanwhile, the dollar's share has dropped to just 42%, the lowest in 3 decades. Central banks are quietly signaling that real money is regaining ground against paper currencies. These shifts matter because they show where confidence is moving. If nations choose to settle trade in yuan or gold while building reserves in silver and other metals, the dollar loses its anchor role. What we are witnessing is not a price spike, but the foundation of a new financial order built on tangible value. The pieces are falling into place. Trump's tariffs have weakened US consumption. India is leaning toward Russia and China, and Central Asia's resources are being locked into Beijing's supply chains. Precious metals are shouting the warning: silver at multi-year highs, gold at reserve records, and the dollar sliding. Together, these shifts point to a world where Washington no longer calls the shots. So what do you think? Has BRICS already cornered the US economy? And how high could silver climb from here? Share your thoughts, hit like, and subscribe. We're tracking history as it unfolds.